Hello?
Right here.
Oh, there you go. There we go. Hey, hi everyone. And today we're going to be talking about everything you need to know about mortgages. I'm Serge with FindMyHouse.ca and eXp Realty, and today I'm with Chita from TMG, the Mortgage Group. Hi, Chita.
Hi, Serge.
Yeah, Chita. Can we start with maybe you telling me what a mortgage is and their purpose?
What is a mortgage? A mortgage is a financing that's required for to purchase a real estate property. So there has to be an asset involved for an asset involved for the loan to be securitized against. So that's essentially what a mortgage is. It's anything to do with an actual physical asset.
Mhm. Okay. So, what be the purpose? Of course, I guess.
Well, to buy a house. So a mortgage is necessary to finance a purchase of a house, or let's say consolidate debt. So basically it's financing for real estate.
And is there another purpose for what you might want to do?
Oh yes. So we'll allude to the fact that there's a few reasons why you'd want to get a mortgage. So typically, anyone looking to buy a house, you would do it for a purchase. Anyone who currently owns a house, they want to do a refinance. So a refinance essentially is when you own a house, you would get a new mortgage, and the new mortgage would replace the old one. It's a way to consolidate debt, and typically try to find a lower interest rate, and to make payments lower, more manageable. We also do mortgages for a time of renewal. So when you've got clients who their maturity is coming up, and they need to look for another option. So typically, if they don't need to take equity out of their house, they just want to carry into another term, we can switch them to a different lender if the new lender offers a better interest rate. And also, anyone who owns a house and who's looking to buy a new house and they want to take their existing mortgage with them, that's called porting. That's another type of mortgage that we do. So you're not redoing the mortgage, you're just taking the existing mortgage from one property to the next. So those are the typically the four scenarios that you would need a mortgage.
So, talking about porting a mortgage, now what if, for instance, they're in a current home, it has a $400,000 mortgage, they want to port it to their new home, which might be at 600,000, and now we have a shortfall, right? How would we address that?
Yes, so we would keep the existing mortgage intact, that 400,000, move it over to the next property, and whatever additional funds, we would just add on the additional funds at the current mortgage interest rate, so that we can make up the shortfall. So then you'd have the old mortgage that's been ported over with the additional top up of additional funds, and then typically lenders will combine the two. They'll do a blended rate, a rate on the blended average.
Okay. Now, obviously, we're talking about porting a mortgage and doing maybe an add-on, and of course, the original mortgage would be at whatever the original rate was, and the new mortgage, or the top up, would be at the current rate.
Mm-hmm.
Might there be reasons why they don't want to port that mortgage?
Absolutely. If the existing mortgage is at a higher interest rate than what is in the current market, it might be more cost effective, and you would be further ahead by paying the penalty on the existing mortgage just in getting an entire new mortgage at the new current lower interest rate. So that is a number that a calculation a mortgage broker would easily be able to calculate for you to see which option would be more ideal.
And can you tell me a little bit about the different kinds of mortgage products available?
Um, yeah. There's so the standard typical is what we call a mortgage, and a mortgage is something. It's a loan that has an amortization period. So basically, the payment itself will have a principal and an interest component, and over the time, when you're making the mortgage payment, it's paying down that principal. So that would be a mortgage, right? Also, there's another product that you can get. It's called a home equity line of credit. And if anyone's familiar with the personal line of credit, it works in the same manner where there's a limit, right? And based on that limit, you can basically make a payment towards just the interest, or you can make a payment towards the interest and principal, but it's revolving. And that's what a home equity line of credit, just like a personal line of credit would be. It's like you can pay down and re-advance it. So you'll always have that limit and you can continuously use it as cash flow. Typically, it's a very popular product that I find anyone who's self-employed and they need that cash flow just to be able to access their equity of their homes readily to be able to run their day-to-day business. So you can do a product of just a mortgage, you can do a product just a home equity line of credit, or a combination of both. So you can shake up your $600,000 purchase with a combination of one or both products.
Right. Now, again, we're talking about a home equity line of credit, but typically we have a different term that we use in the industry for this product, and maybe people out there have heard that term. What would that term be?
It's the acronym HELOC. So
HELOC.
Yeah, it's the acronym. So H Home Equity Line of Credit. So anytime you're hearing a mortgage broker, anyone talking, and they're using a HELOC, that is a home equity line of credit.
Okay, perfect. Now, I often hear people talking about hearing different terms and such as amortization. Can you tell us what those common terms might be?
Yeah. So anytime you're talking to a mortgage broker or you're looking at your mortgage commitment, right? Your mortgage contract, the common terms you are going to see is amortization. So amortization is the entire life of the mortgage. And what standard is a 25-year mortgage, right? So you have this extended amount of time that that it'll take 25 years to pay off your mortgage. So that's one terminology. The other term, the other definition that's very common is your term. And that means it's a contractual time within that entire amortization of 25 years. So for example, a very common term duration is a 5-year term. So typically what a client would do, and because the terms can range from 6 months to 10 years, right? So you'll take, based on your entire 25-year life, right? You can take initial 5-year term when you first buy a house, and then when you're up for renewal, you decide, hey, I may consider selling in the next couple of years, 2 to 3 years. Maybe I'll take a shorter term, so I'll take a 2-year term, right? So you changed from a 5, you're done with a 5, now you're in a 2. Once you buy a new house, maybe you'll lock yourself into another 5-year term. So how you shake up that 25 years of the entire life of your mortgage in these different years of contractual times, and so that's what we call terms.
Okay. Now that they've selected, say, a term, whether it be 6 months or 5 years, what about payment frequency and how that affects, how does those options affect the outcome?
Yeah. So payment frequency. So how you pay, when you pay for your mortgage is what we call like the payment frequency. So you can choose monthly payments, biweekly, semi-monthly. Semi-monthly is twice a month, whereas biweekly is every 2 weeks, and end up being there'll be a couple of months with 3 payments, right? So and then you also have weekly payments. So that's a payment frequency. And so you can choose to do either of those options. And then there's an option to do what we call accelerated payments. So it's a very common thing to do on a bi-weekly schedule. So as I said, a bi-weekly is every 2 weeks. However, there's going to be a couple months where there'll be 3 payments. So there's 26 payments in an entire, a bi-weekly throughout the year. And by doing accelerated bi-weekly, you're taking the monthly payment, you're halving that, but because you're making those extra 2 payments, you're paying down your mortgage faster so that entire 25-year amortization gets scaled back because you're making additional payments into your mortgage every single year because you're on an accelerated schedule.
Right. Yeah. No, I know personally, I just, last couple of years, purchased a new home, got a 30-year amortization. And the fact that I chose that accelerated biweekly payment, which is great because you can have it, most people get paid every 2 weeks, and you can have it scheduled for right after you get your paycheck deposit into your bank account. But what it did is it took my 30-year amortization, and if by just doing it biweekly, accelerated biweekly, I should have it paid off in 22 and a half years. Mm-hmm. That's a lot, going from 30 years to down to 20 22 and a half years. I mean, I don't know why anybody wouldn't want to do that, but there we go. Is there different amortization options for first-time home buyers?
No, I guess no, it's not based on if you're a first time home buyer or not. Oh, sorry. So as of December 15th of last year, the insured mortgages, right? Insured mortgages, first time home buyers are now allowed to do 30-year amortization, as in the past it was only 25 years. So anyone who's first time home buyer doing 5% down can now have 30-year amortization. If someone who's already owned a home and they're deciding to move to purchase another property as an owner occupied because they've already owned a home, then they're maxed out at 25. So the first time home buyer is now allowed to do 30-year amortization, whereas if you're buying another property that you've already owned a property in the last 4 years, it's maximum 25 years if you're doing the 5% down.
Now, correct me if I'm wrong. If a buyer has minimum of 20% down, they may also be eligible for 30-year amortization, correct?
Correct. So having having 20% down on a purchase, whether you're first time, second, it doesn't matter on any property, you're eligible for 30-year amortization, correct.
So we had talked about a fixed rate mortgage earlier, but what about variable rate mortgages? What are those and how do they work?
I don't recall talking about fixed rates. But okay, maybe I'll reiterate
maybe start with fixed rate and we'll go from there.
Okay, we'll start with the fixed. Okay, so a fixed, so when we talked about the term, the contractual time, 6 months to 10 years, we get to kind of decide what that we look at what the rate choice is. And the rate choice is either going to be a fixed rate over that term, right? That contractual period. The fixed rate is a guaranteed rate and payment over the time of that term. So if you take a 5-year fixed rate, your interest rate and your payment does not change over the 5 years, which I think is it's a peace of mind for a lot of first-time home buyers, especially with, Bank of Canada announcements, I guess the uncertainty of trade war that's happening right now. It's, a guaranteed payment, and any news article or headlines doesn't have to keep you up at night. Variable interest rates, on the other hand, we considered are a floating rate, right? So the floating rate is because it's basically it can fluctuate with the bank prime rate, and prime rate is set by Bank of Canada when they make their announcements, and Bank of Canada will set prime rate to kind of adhere to, I guess, their monetary policy, depending on what the global economy is doing, right? So we've seen that the government, the Bank of Canada, has decreased rates, right, in the last little bit here, just because we had this, we didn't understand, we knew the effects of the tariff was going to cause a lot of havoc in our economy. We want to keep our economy afloat. So by reducing the prime rate is to encourage spending and to kind of safeguard our economy. Right, so that prime will fluctuate based on Bank of Canada, and that variable interest. If you take a variable interest rate, your rate can change over the term of your mortgage, and your payment will also change because of that rate change. So it's not a guarantee.
Okay, can you maybe talk about the differences between an open mortgage and a closed mortgage?
Yes. So an open mortgage means that there's no restrictions on whether you can pay any or all of that loan off at any given time, right? So basically, your home equity line of credit, right? It's a line of credit that you can pay. It's considered open because you can pay the entire balance off without a penalty. There's no restrictions. Right? So you can, pay down, readvance, pay down. So that's considered open. Whereas if you have a closed mortgage term, means that there's going to be restrictions on how much you can pay down every single year. And anytime you pay more than that, you're penalized on that, on what you pay off, because the contract that the term contract that you made with the lender is that, yes, we are on, we've agreed to pay this mortgage over this duration of time. If you decide that you no longer, you don't want this contract, or you pay it out, there will be a penalty that's applied because I guess you haven't agreed to fulfill that contract to the very end.
Okay. What about prepayment privileges?
Mm. So, like I said, with a closed mortgage term, there's a restriction, right, on how much you can pay off, and so basically we call those not the restrictions, or the guideline as to what you can pay off is a privilege. So standard is 15 to 20%. You're allowed to pay up to 15 to 20% of your original mortgage every single year without a penalty. So you can make additional lump sums into your mortgage, um, without being charged. It's still within the contractual agreement, and so it's a way that you can pay it off faster, right? So it's a privilege that you're allowed to be able to make to pay down your principal faster.
Now, you said that they, of course, can uh, prepay on what we call their anniversary date, right? Can they
Mhm.
also increase their monthly payment or whatever frequency they have? Can they increase those payments?
Correct. There's two very common privilege is, you can exercise a lump sum.
Mhm.
So you can make, so very common, you get a tax return, right? And you have a lump sum of money. You can let the lender know on the next payment date, can you withdraw this amount of money as well? And that lump sum gets applied right to the principal. So you can do that lump sum avenue, or you can increase your payment. So typically it's, 15 to 20% annually. You can increase your payment so it's reoccurring without you having to prompt it every single time. So you can increase that payment, and everything you end up increasing or adding towards your mortgage goes right to, bringing down that principal.
Okay. What about prepayment penalties?
Yes. So the prepayment penalty is the penalty that, based on your contract, you had these, restrictions and guidelines of how much you can pay down. But if you overpay, you're penalized on that extra, right? And so there is, and also if you pay it all off, when you pay it all off by selling your house and not rebuying, or you decide to switch to a different lender, you decide to refinance, midterm. So at that point, because you're ending the contract early, there'll be a penalty that's applied to whatever the balance is, and they typically take the higher of a 3 months interest, or what we call an IRD, interest rate differential, and whatever calculation equates to a higher penalty is what the lenders will charge you. So basically, every contract will have to outline a prepayment privilege, as long as as well as a prepayment penalty.
Okay. Now, you know, do all do all lenders charge a prepayment penalty, and do they all charge the same prepayment penalty?
I know this is a bit of a bone of contention that I have with some banks and lenders, when I find that they're quite unfair with their penalty calculators. So it's different. It's very different. So the banks have, so the 3 months interest is, it's relatively easy to calculate, right? That's easy, and you're hoping that that's the higher interest rate, right? The higher penalty that you're going to be charged. But the IRD can range from, a couple thousand to, I've seen, 10, 20. I think that the largest one I've seen, like, of recent, was $25,000 penalty. So that interest rate differential, and what it is really is, it's they'll take whatever's on your contract rate, what's the current market interest rate, find the differential, multiply that by the balance and the time remaining on contract of your term till end, right? So it's like you're essentially buying out your contract, and the loss of what the bank was essentially going to make on your money, had you continue to, pay as agreed on your mortgage. So, but that current interest rate that the banks and lenders use to find the differential, banks and lenders have lots of different rates that they can use. They're posted, their contract, right? I mean, they can find, if a bank wants to gouge you, they want to find the biggest range difference of their rate, so that they can multiply that to get a bigger penalty. And there's no standardized formula of what rates they're allowed to use. So that penalty can differ from different banks and different lenders. So it's something to always consider when you're choosing a mortgage lender. It's not just about, and like I've always mentioned, it's not always about the interest rate. That penalty could offset your cost savings if you choose, a lender that is not unfair, but will charge you the higher penalty, right? So, yeah, it's not the same. It's not standardized. They can choose whatever rates that they want.
Okay. So obviously, if that's important to that particular client, you can advise them at which lenders might be more favorable as far as their prepayment penalties.
Correct. When I'm having a conversation about, okay, you're buying a house, which lender to choose, why this lender, why did I choose them? It's definitely, if you have clients where they can go anywhere, they're with any lender and an institution, those are one of the markers that I choose to make sure that, you know what I mean, that I consider when choosing them, right? Choosing a lender for the client. But some clients, they fit into one or two, and that's just not an option, right? So, but to consider that, yes, this bank or institution typically has a higher penalty calculator, so we may want to consider that term and what your future plan with this property will be, so that we are not going to, you know what I mean, if things do end changing, or you're with your plans, like, you don't end up having a massive penalty.
Okay. So when it comes to first-time home buyers, you typically suggest the type of mortgage, amortization, and terms that they should consider, and what are the reasons for them to consider those recommendations?
What are the reasons why they should consider my recommendation?
Right. So when you're dealing with a first-time home buyer, do you suggest to them that the amortization term
Yeah.
should be looking at?
Yeah, so there is a conversation. So a lot of times, the conversation is like, you're buying a house. A lot of first-time home buyers, when we're buying a house, their amortization typically, the discussion really is about payment, right? This is what the amortization looks like, right? Like, people don't come and say, I choose 25 years. No, a lot of times, what does that payment look like? And does that payment, is it manageable for this period of your life, right? Like, you're going into a house, is it manageable with your finances, right? So it is a conversation about, like, hey, you guys, you got a large down payment. I mean, you make great income. You can manage a higher payment. What does that look like if we, scale back the amortization to, let's say, 15 years? Is it something that it'll still allow you to live your quality of life with that higher payment, right? So there is that conversation with some clients. A lot of times, first clients, they just want to get the lowest payment possible and get into their home. And sometimes the conversation is because at renewal time too. So at renewal time is also a great time to have a conversation about, you know what I mean? You can decrease your amortization at renewal time. So that one decision at that 5-year term or whatever your term when you buy a house isn't the be all end all. It's not it may not, you know what I mean? Like, it doesn't mean like you're locked in for the entire 25 years. Right? It might just be like, hey, let's get you grounded, let's get you, into home ownership, get comfortable. And then the conversation about, hey, you guys are, you've got excess savings over the last how many years, you can afford a higher payment. Maybe let's start looking at making that payment higher and shorten your amortization. So these conversations, that's great about having terms throughout the 25 years. These discussions can happen within, so that we can start, you know what I mean? So we can start doing things where that's more in line with their financial goals.
Okay. Well, when I'm out there working, and what I typically find with buyers is that no matter what, they're always looking for the best and lowest payment, best interest rate, lowest payments. And that's one of the reasons that, of course, I recommend Chita to all of my clients, is because typically, she can access lenders that have the lowest rate, and it's typically not the banks.
Yes, correct. So a mortgage broker has options that consumers don't have access to. So your big banks, your big 5 banks. So Canada's Canada's banking system basically, the large market share is basically your big 5 banks. It's because the 5 banks have spent tons of money to market to the consumers. They're the ones that you see in the commercials. They're brands you see everywhere, right? But then there's also lenders and institutions that don't advertise to the consumers. They don't have that kind of big marketing budget, and they advertise to us, the mortgage brokers. We are literally the, between, we're the ones that introduce them to the clients, because the borrowers wouldn't know who they are. It's us mortgage brokers. They spend the time to educate us mortgage brokers and advertise to us, right, on a smaller scale. We don't, not a big marketing budget. And then the cost savings that they typically have, they can extend to the consumers, because they don't have these like massive, like, yeah, you're not on, your name's not on, I guess, Scotiabank is tied with Rogers Place. Like you see the big banks just spend so much money to brand themselves, where a lot of these monolines, we call them monolines, or institutions that lend Canada wide, don't have that kind of budget, but their interest rates and their penalty calculations are much more fair. And I find that here's a disclosure. I have a couple mortgages and neither of them are with the bigger banks. I absolutely would not, right? Unless I needed their products, but neither of my mortgages are with the bigger banks, because I know that, the bigger banks typically are, I guess they just, the calculations, the penalty calculations. It's just, for me, I just don't believe in the fact that they do the best for the clients. And so it's the mortgage broker having that discussion with the consumers.
Okay. Well, if someone wanted to contact you or for pre-approval or refinancing or transfer of a current mortgage, how can they reach you?
My phone number is on the screen. My phone number, call, text, email. You can email me, Chita, Chita, at EDM, first three letters of Edmonton-mortgage.ca. I am also on social media, so you can find me on social media. I check my DMs not as often though, so my response time is delayed. But I mean, if you're hitting me up on the phone and my DMs, you're definitely going to get a quick response.
Wonderful. Well, Chita, I want to thank you for sharing this wonderful information. I hope that everyone out here learned something and able to use what we shared with you today for you to make the right decision when it comes time to buying a home and getting your next mortgage. But for today, we're going to let you go and wishing you a wonderful day. Bye now.
Bye.